Hello, my dear students. A very warm welcome to all of you in Sri Jaindra Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll begin with Accounting Chapter 6, Unit 4, that is Average Due Date. So let us begin. This is lecture number 1, Chapter 6, Accounting for Special Transactions, Unit 4 in particular, Average Due Date. Let us begin with the learning outcomes. After studying this chapter, you will be able to understand what is average due date and how to choose 0 day for calculating average due date. Learn the technique of calculating the due date. Learn calculations of average due date where the amount is lent in various installments. Calculate average due date for determining the interest on drawings. Familiarize with the steps involved in calculation of average due date, where amount is lent in one installment but repayment is done in various installments. Also, understand days of grace and learn the technique of maturity date by continuing the days of grace. Unit overview. Uses of average due date for calculation of interest on drawing of partners, where the amount is lent in various installments, where the amount is lent in one installment. Calculation of average due date or calculation of due date of bill oblique invoice is payable on a specific date. Due date will be on the specific date. At a stated number of months oblique days after date, due date will be on that date which comes after adding stated number of months oblique days of the date of invoice plus 3 days of grace. Grace is applicable on bill, that is bills of exchange or promissory notes. Introduction. In business enterprise, a large number of receipts and payments by and from a single party may occur at different point of time. To simplify the calculation of interest involved of such transactions, the idea of average due date has been developed, where a person owing several amounts due on different dates desires to pay the total amount payable by him or her on one single particular day or date, so that neither the debtor nor the creditor stands to lose or gain anything by way of interest. That date is known as average due date. Average due date is weighted average of due dates of various transactions where amount of each transaction is used as weight. The unique feature of this approach is that the party making payment neither shores any loss nor gains anything by this arrangement of making a single payment. Average due date is generally used in the following circumstances: for calculating interest on drawing of partners, for settlement of account between the principal and the agent, for settlement of account between the principal and the agent, for settling contra accounts, example where parties sell goods to each other, for making lump sum payment against various bills drawn on different dates with different due dates. In this unit, we shall elaborate the underlying principle of determining average due date, covering the cases where the amount is lent in various installments but repayment is made in a single installment, as well as where the amount is lent in one installment but repayment is made by various installments. The technique of average due date is also useful for calculating interest on drawing made by the proprietor or the partner of a business firm at several points of time. average due date, it is mean or equated date on which a single total payment may be made in lieu of the different payments on different dates without any loss of either party. Where payment is not made on average due date, the party receiving the amount charges interest for as many days as the payment is delayed from the average due date. The formula for calculating average due date is as follows: average due date equal to base date plus total of the product divided by total of amount column. Product oblique amount. We'll learn about it when we do the sums. Points to be noted in case of average due date. Selection of base date or zero date. Such a date may be the due date of the first transaction or due date of the last transaction or any other due date between the first and the last transaction, but preferably earlier due date may be taken. In our examples, we'll take it as the base date as the date of first transaction. Next, while ascertaining the number of intervening days plus or minus between the base date or due date of each transaction, ignore the first date and include the last date. Next, if due date is fraction, round it off. Next, if amount is paid before due date, a rebate is given. If amount is paid after the due date, interest is charged. Whenever there is a sale of goods by two persons to each other on different dates, the formula for calculating average due date becomes base date plus minus difference in product divided by difference in amount. When we do the sums, we'll be able to understand this formula in a better manner. Concept of due date, date of maturity. The due date of the bill of exchange invoice is the date when the amount of bill invoice is payable by the drawing creditor to drawer debtor. Calculation of due date after taking into consideration the days of grace. Generally, the days of grace is 3 days. Let's take an example. A bill of exchange or promissory note matures on the date on which it falls due, and every promissory note or bill of exchange other than those payable on demand, at sight, on presentment, except these three cases, falls due on the third day after it is expressed to be payable. Example, a bill dated 30th September is made payable after 3 months. 30th September plus 3 months, it falls due on 2nd January. So due date is 30th September plus 3 months, 30th December plus 3 days of grace, 30th December, 31st December, 1st January, 2nd January. So 2nd January. Maturity date is 2nd January. A note dated 1st January is payable 1 month after sight. It falls due on 4th February. Calculating due date of bill or note payable few months after date or sight. When the bill is made payable at a stated number of months after date or after sight or after certain events, then the period stated shall be held to terminate on the date of months which corresponds with the day on which the instrument is stated. If the month in which the period would terminate has no corresponding day, the period shall be held to terminate on the last day of such month. Example, a bill due on 29th January is made payable after 1 month. The due date is third day after 28th February, that is 3rd March. February is of 28 days only. I believe you understood. Let us move ahead. Calculation of due date when the maturity day is a holiday. When the day on which the promissory note or bill of exchange is at maturity, after including the days of grace, 3 days of grace, is a public holiday, The instrument shall be deemed to be due on the preceding business days. In case of public holidays, it is preceding business day. The expression public holiday includes Sundays and other days declared by the central government by notification in the official gazette to be a public holiday. And now, if the preceding day is also a public holiday, it will fall on the day preceding the previous day. But if the holiday happens to be an emergency or unforeseen event, in that case, the next following day will be the due date. Next following date, as per the Negotiable Instrument Act 1881. If maturity day is a holiday after including the days of grace, and that is a public holiday including Sundays and other days declared by the central government in the official gazette, due date will be a preceding business day because you already know in advance that this due date is a Sunday. If preceding day is also a public holiday, due date is the day of preceding to the previous day. That means preceding business days. I believe you understood. But if the due date is holiday, is an unforeseen holiday or emergency holiday, then due date will be the next following day. I believe you understood. Types of problems that needs to be solved in average due date. Learn calculation of average due date where one party is involved. Learn calculation of average due date where the inter-transactions between the two parties are involved. Learn calculation of average due date where the amount is repaid in installments. Learn calculation of average due date where determining the interest on drawings. I believe you understood till here. Let us move ahead. Do some notings. Average due date is the date on which a person can pay all the sum due to another person without resulting in gain or loss to either of the contracting parties. If the payment is made before the average due date, it would result in gain to the creditor and loss to the debtor if the payment is made after the average due date. It would result in gain to the debtor and loss to the creditor. Calculation of average due date. Due date. First column is due date. Second column, number of month from base date. Amount and product at last. Due dates are 1st of June, 1st of July, 1st of August. Base date will take the first date as base date, 1st of June. From 1st of June to 1st of June, 0 months. 1st June to 1st July, 1 month. 1st June to 2nd July, 2 months. Take amount as 10,000, 10,000, 10,000. Product 10,000 multiplied by 0 is 0. 10,000 multiplied by 1 is 10,000. 10,000 multiplied by 2 is 20,000. Total of the product column 30,000. Total of the amount column 30,000. Formula to calculate average due date equal to base date plus product divided by amount. Base date is 1st of June. Product is 30,000. Amount is also 30,000. 1st of June plus 1 month. So average due date is 1st of July. Average due date is 1st of July. I believe you understood. Let us move ahead. Write a note over here. Calculation of average due date is made taking duration in terms of number of days. However, when all the due dates are either month beginning or month end, duration can be taken in terms of number of months. I believe you understood. Let us continue. Calculation of average due date. First column is due date. Number of month from base date. Amount and product. Due date 1st June, 1st July and 1st August. As I told you, we'll take the first date as due date, the base date, but you can take any date as due date. So in this example, we are taking 1st July as base date. 1st July as base date. From July to June, this is -1, 1 day, 1 month before. 1st July to 1st July 0, and 1st July to 1st August is 1 month. Amount is 10,000, 10,000, 10,000. Total 30,000. Here it would be -10,000. Here it is 0, and here it is 10,000. The sum of product column is 0. Average due date equals base date plus product upon amount. Base date 1st of July, 0 upon 30,000. 1st of July plus 0 month. The due date 1st of July. I believe you understood. I believe you understood properly. Let us move ahead. Take an example. Example. Due date number of months from base date, amount, and product. Due date is 1st July, 1st August, 1st September. Take base date 1st July, the first date as base date. July to July, 0 month, 1 month, 2 month. Amount is 10,000, 10,000, 20,000. Total 40,000. Product is 0, 10,000, 40,000, 50,000. Average due date equal to base date plus product upon amount. First of July plus 50,000 divided by 40,000. 1st July plus 550,000 plus divided by 40,000 is 1.25 months. 1.25 months. This means 1st July plus 1 month plus 0.25 months, convert into days. 0.25 multiplied by 30 is 7.5, equivalent to 8. 8 days. Due date is 9th August. The average due date is 9th August. Let us continue. Next. Calculation of average due date when all the amount payable is similar. Take an example. Due date, number of months from base date, amount, product. Due date is 1st June, 1st July, and 1st August. Base date is 1st June. So 0 month, 1 month, 2 month. Amount is similar, say same, that is XXX. Total is 3x. Product 0x, 1x, 2x. 0 plus 1 plus 2x. I believe you understood till here. How to calculate average date in these cases? So average due date equals base date plus product divided by amount. Base date is 1st June. Product is 0 plus 1 plus 2x by 3x. Xx cancelled. Now students, you should understand one thing. What is this 0 plus 1 plus 2? This is the number of months. 0, 1, 2. This is the number of months over here. And this is the total of amount 3. So in that case, you can use another formula also when the amount is same and the amount payable in all the bills is same. You can use another formula. 1st June plus summation of duration. 0 plus 1 plus 2 is nothing but summation of duration. See? And this 3 is the number of due dates. 1, 2, 3 due dates are there. So divide by number of due dates. So average due date equal to base date plus summation of duration divide by number of due dates when the amounts payable is similar. I believe you understood. Let us continue. Due date in case of promissory note or bills of exchange. When promissory notes or bills of exchange is payable on site, on demand, on presentment. In these cases, due date is calculated without considering grace days, that is 3 days of grace, due date is the date on which bill matures. Bill matures. Next, when promissory note or bill of exchange is payable on terms other than those given above, due date is the third day from the date on which bill matures, that is 3 days grace days is allowed. I believe you understood. I believe you understood this. Let us take few examples to understand. Example: calculate due date in all the given below cases. Case 1. 1 month bill payable on site drawn on 1st May 2013. 1 month bill payable on site. So 3 days of grace is not added over here. The answer is 1st June 2013. Next case. 2 month bill drawn on 2nd February 2014. It is 2nd April 2014. So it would be 2nd April 2014 plus 2 months plus 3 grace days would be added, because this is not on site on presentment on demand. Second 6 2014 plus 3 grace days, it is 5 6 2014. I believe you understood. Let us continue. Case 3. 1 month bill drawn on 30th November 30th November plus 1 month plus 3 grace days, 30th December plus 3 grace days equals 2nd January. Next. 1 month bill drawn on 31st October so 31st October plus 1 month plus 3 grace days. There is no date called 31st November, so it would be 30th November, the last day of the month, plus 3 grace days, 3rd December. Next case, case 5. 1 month bill drawn on 28th February 2014. So 28th February plus 1 month plus 3 grace days. So 28th February to 1 month, that is 28th March plus 3 grace days, 31st March. 31st March. Next. 1 month bill drawn on 31st January 2014. 31st January plus 1 month plus 3 grace days. 31st January to 1 month is 28th Feb plus 3 grace days. This is 3rd March. Next case, 7th. 1 month bill drawn on 28th January 2014. 28th Jan plus 1 month plus 3 grace days equal to 3rd March. I believe you understood. Let us continue. Right, note. If the corresponding date is not in the given month, then last day of such month is taken. Example, 31st January, 1 month. So 31st February, but 31st February generally is not there. So 28th February is the last day of the month. 28th February, 1 month. So 1 month completes on 28th March. I believe you understood. Let us continue. Case 8. Cash sales on 15th Feb 2014. Payment not yet made. Due date same 15th Feb 2014 because this is a cash sale. Next case, 1 month credit, 1 month credit sale on 15th Feb 2014. So 1 month completes on 15th March. The due date is 15th March. This is not a bill, so grace days will not apply over here. I believe you understood. Let us continue. Due date in case due date including grace days falls on holiday. In case due date falls on holiday, which is notified in advance by central government, including Sundays, due date shall be immediately preceding business day. Next, in case due date falls on holiday, due to band or red alarm, all of sudden holidays. In case due date falls on holiday due to Bandh, close down, red alarm, all of a sudden holidays, in that case, due date shall be immediately succeeding business day. Immediately succeeding business day. I believe you understood. Right, for examination purpose. For examination purpose these days as public holiday 26th January, 15th August, 2nd October and 25th December. Consider Sundays only if given in question paper. Many a times it happens that the question which comes in exam will be of nearly 1 or 2 days before. You know that this day is a Sunday, but don't assume it till the time the question don't specify that day is a Sunday. I believe you understood. Let us continue. One month bill drawn on 12th July. From 12th July to 1 month, 12th August plus 3 days of grace. So 12th July plus 1 month plus 3 grace days. It is 15th August. But 15th August is a holiday. So one preceding business day. So 14th August. But 14th August is a Sunday. So in that case, the answer would be 13th August. But this 14th August is Sunday should be given in the question. You can't assume it. I believe you understood. Let us continue. Calculation of average due date in case of mutual dealings when two parties are involved. Mutual dealings. There are two parties A and B. A needs to make two payments to B, first payment and second payment. The total of these payment is 25,000. B needs to make three payments to A. The total of these three payments is 30,000. So in that case, if B will pay the difference, that is 5,000 to A, will it be fine? Yes. But on which date? that average due date needs to be calculated. For A's payment, how we'll do the calculation? Due date, number of days from due date, amount, product. Total of amount, total of product. Total of amount is termed as A over here and total of product is termed as B over here. For B's payment, due date, number of days from due date, amount, product. Total of amount is termed as C over here and total of product is termed as D over here. I believe you understood till here. I believe you understood. Let us continue. How average due date is calculated? Base date plus difference in product divided by difference in amount. Difference in product divided by difference in amount. These are the product B and D, the difference between two, and amount A and C, the difference between two. There is a crux over here. Difference in amount means higher amount minus lower amount. Difference is amount in amount means higher amount minus lower amount. Supposingly higher amount is A and lower amount is C. So A minus C. Difference in product means product whose amount is higher minus product whose amount is lower. So difference is amount. Supposingly A is higher amount. So A minus C. Difference is product means B minus A. B minus A. I believe you understood this. Let us continue. Question number 1. Radhesham purchased goods from Hari Ram. The due dates for the payment in cash being as follows. 15th March 400, the due date is 18th April. Next transaction date is 21st April. 300, the due date is 24th May. Then 27th April 200, the due date is 30th June. 15th May 250, the due date is 18 July. Hari Ram agreed to draw a bill for the total amount due on the basis of average due date. Ascertain that date. Okay. Solution. Calculation of average due date. Select the base date first. We are taking this date as base date, the first date. 18th April is the base date. Make 4 column. Due date. Number of days from due date. Amount and product. Due date is given in the question. 18th April, 24th May, 30th June and 18th July. 18th April, 24 May, 30th June and 18th July. So this is the base date. So 0 month, 0 days, 18th April to 24th May. 18th April to 24th May. Do it on your calculators. Calculate the days. 30 minus 18. So in April there are 12 days plus 24. 36 days. 24 days of May. So 36 days. This is 30th June. April 12 days. May 31 plus June 30. 73 days and 18 July. So 30 June to 18 July. 73 plus 18. This is 91 days. I believe you understood. Amount 400, 300, 200 and 250. 400, 300, 200 and 250. Do the totals. 1150. Product. 400 multiplied by 0 is 0. 300 multiplied by 36, 10,800. 73 multiplied by 200, 14,600. 91 multiplied by 250, 22,750. 48,150. The sum of product column. Average due date equals base date plus product divided by amount. So 18th April is the base date plus product 48,150 divided by amount 1150. So 18th April plus 42 days. 30th May is the average due date. 30th May is the average due date. I believe you understood. 30th May is the average due date. Next question. Question 2. Calculate the average due date from the following information. Date of bill is given, terms is given and amount is given. Solution. Calculation of average due date. We need to select the base date first. Make these columns. Date of bill, term which is given in the question. Due date we need to find out. Then same columns. number of days from base days, amount, and product. Date of the bill 10th August 2007, 10th August 2007, 23rd October 2007, 4th December 2007, 14 January 2008, 8 March 2008. Term is given in the question: 3 months, 60 days, 2 months, 60 days, and 2 months. So calculate accordingly. If month is given, calculate month. If days is given, calculate days. 3 months, 60 days, 2 month, 60 days, 2 month. 10/8/2007, 3 months. So 10/11/2007, 11/12/13, 3 days of grace. Due date is 13/11/07. 60 days, 23rd/10/2007, 60 days. This is 24th December 2007. 4th December 2007, 2 months. So 4th February 2008 plus 3 days. 7 February 2008. 60 days, 14 January 2008. 60 days, it is 17 March 2008. 8th March 2008 and 2 month, it is 8th May 2008 plus 3 days of grace, 11 May 2008. This is the base date. Take this date as base date. 13/11/2007. 0 month, 0 days, 41 days, 86 days, 125 days, 180 days. Do it on your calculators. Amount as given in the question: 6,000, 5,000, 4,000, 2,000, 3,000. 6,000, 5,000, 4,000, 2,000, and 3,000. The total is 20,000. Product: 6,000 multiplied by 0 is 0. This is 2,05,000. 5,000 multiplied by 41 is 2,05,000. 86 multiplied by 4,000 is 3,44,000. 125 multiplied by 2,000 is 2,50,000. 180 multiplied by 3,000 is 5,40,000. Total of product: 13,39,000. Average due date equals base date plus product divided by amount. This is the base date, product divided by amount. Do it on the calculator. 13,39,000 divided by 20,000. 66.95. 67 days. 67 days from here. It is 19 January 2008. This is average due date. I believe you understood. Let us continue. Question 3 is same as question number 2. Do it in homework. Write its answer. Writes its answer is 23rd January 2008. Do it in homework. Next question. Question 4. E owes to F the following amounts: rupee 5,000 due on 10th March 2007, rupee 18,000 due on 2nd April 2007, rupee 60,000 due on 30th April 2007, rupee 2,000 due on 10th June and 2007. He desires to take full payment on 30th June 2007 with an interest at 10% per annum from the average due date. Find out the average due date and the amount of interest. Okay. Calculation of average due date. Finalize the base date first. We will finalize this first date as base date 10th March 2007 as is it is readily given. Make 4 columns. Due date, number of days from base date, amount and product. 10th March 2007, 2nd April 2007, 30th April 2007, 10 June 2007. From base date, it is 0 days, 23 days, 51 days, 92 days. Amount 5,000, 18,000, 60,000 and 2,000. 5,000, 18,000, 60,000 and 2,000. Total is 85,000. Product 0, 4,14,000, 3,60,000, 18,04,000, 1,84,000. Product 36,58,000. Average due date equals base date plus product divide by amount. Base date is 10th March 2007 plus product divided by amount. 43 days. 22nd April 2007. This is the average due date. In the question, it is given that E desires to make payment on 30th June 2007. So he needs to pay interest at the rate 10%. E desires to make payment on 30th June. Period of delay 69 days. Interest payable equals 85,000 multiplied by 10%, 69 upon 365. Calculate it quickly. 1607. 1607. Total amount payable by E to F on 30th June, 85,000 plus 1607, 86,607. 86,607. I believe you understood. I believe you understood this. Suppose in this question only, suppose E desires to make payment on 31st March 2007, that is early. Period of early payment, average due date is 22nd April 2007, so it is 22 days. 22 days early. Interest receivable equal to 85,000 multiplied by 10% multiplied by 22 upon 365 equals, do the calculations quickly, 512. So final amount payable on due date equals 85,000 less 512, 84,488. 84,488. I believe you understood this. Next question, question 5. Mr. Green and Mr. Red had the following mutual dealings and desired to settle their account on the average due date. Purchase by Green from Red, amount, sales by Green to Red, an amount. You are asked to ascertain the average due date. Solution. Calculation of average due date. We need to select base date first. First we will do for Green. For Green payment, make 4 columns. Due date, number of days from base date, amount, product. January 2007, February 2007, March 2007. Amount is 6,000, 2,800 and 2,000. Total 10,800. Select this date, first date as base date, 6 January 2007. Calculate the number of days, 0, 27 days, 84 days. Product, 0, 27 multiplied by 2,800, 75,600. 84 multiplied by 2,000, 1,68,000. Totals, total of product 243,600. This is for green payment. Next, for red payment, we need to make these 4 columns again. Due date, number of days from base date, amount, product. Due dates, these three dates. Amount 6,600, 2,400 and 500. Total of amount column is 9,500. Base date is same, 6 January 2007. So it is 0 months, 0 days, 62 days, 73 days. Product 0, 1488, 00, 365, 00. 185, 300. Average due date equals base date. There are two parties, we need to take difference in product in relation to difference in amount. First we will take differences in amount. 10,800 minus 9,500. Base date is 6 January 2007 plus 10,800 minus 9,500. Difference in product 243,600 minus 185,300. 243,600 minus 185,300. 243,600 minus 185,300 equals 58,300 divided by 10,800 minus 9,500 equals 1300, and this is the base date. "45 days. 20th February 2007. Green will make payment of rupee 3,000 on 20th April 2007 to settle all dues. Why 1,300? See in the question. 6,000 plus 2, 8,000, 10,800, and over here the total is 9,500. The difference is 1,300. I believe you understood. Let us continue to the next question. Question 6. This type of question we have done, so this is homework. Next question. Question 7. Calculate the average due date from the following information. A lent 25,000 to B on 1st January 2007. The amount is payable in 5 half-yearly installments commencing from 1st January 2008. Calculate the average due date, the interest of 10% per annum. Solution. Calculation of average due date. We need to finalize base date first. Due dates. First January 2008, because 1st January 2007, but after a year the amount is repayable 5 equal installments commencing from 1st January 2008. So 6 months from here, 1st July 2008, 1st January 2009, 1st July 2009, and 1st January 2010. Number of months from base date. This is the base date. So 0 months, 6 month, 12 month, 18 month, 24 month. Do the total of the months. 60 months. This question could be done in days also, but it would be easier if you do it in months. Average due date equals base date plus summation of duration divided by number of due dates. Base date is 1st January 2008. Summation of duration 60 months. And there are 5 due dates. 1st January 2008 plus 12 months. 1st January 2009. This is the average due date. I believe you understood. Calculate interest at the rate 10%. Interest payable equals 25,000. Interest is 10% for 2 years. From 7 to 9, 2 years. 1st January 2007 to 1st January 2009. 5,000. 5,000. I believe you understood. Next question, question 8. This is similar homework. Let us move ahead. Question number 8 is homework. Let us move ahead. Question 9. Ram purchased goods on credit. His due dates for payments were as under. Transaction date, amount, and due date is already given over here. Calculate average due date. Solution. Calculation of average due date. We need to finalize base date first. Take the first date as base date, 8th April 2008. 4 columns, due dates, number of days from base day, amount, and product. Amount 300, 200, 275, 400. Do the totals of amount 1175. Number of days from the base date 0 days, 40 days, 66 days, and 91 days. Product 0, 8,000, 18,150, 18,150, 36,400, 62,550. The total of product column 62,550. Average due date equals base date plus product divided by amount 8/4/2008. 62,550 divided by 1175. 8/4/2008 plus 53 days 31st May 2008. Average due date. I believe you understood. Let us move ahead. Next question, question 10. Mehnaz accepted the following bills drawn by Shehnaz on 8th March 2005. 4,000 for 4 months. On 7th April 2005, 6,000 for 5 months. On 16th March 2005, 5,000 for 3 months. And on 17th May 2005, 5,000 for 3 months. He wants to pay all the bills on a single day. Average due date. Find this date. Interest is charged at the rate 18% per annum, and Mehnaz wants to save 150 by way of interest. Find out the date on which she has to effect the payment to save interest of 150. Solution. Calculation of average due date base date. We'll finalize the base date. First we'll find the due date. Date, term, due date, number of days from base date, amount, and at last product. Date given in the question 8th March 2016. Term is 4 months. 16th March 2015 for 3 months. 7th April 2005 for 5 months. And 17th May 2005 for 3 months. Add 3 days of grace. 11/7/2005, 19/6/2005. This is 10/9/2005 and 28/2005. Take this date as base date, as this date is the lowest. So 0, 22 days, 83 days, 62 days. Amount as given in the question 5,000, 4,000, 5,000, 6,000 and 5,000. The totals is 20,000. Total of product column 88,000. This is 0. 6,000 multiplied by 83, 498,000. 5,000 multiplied by 62, 3,10,000. 896,000. Average due date equals base date plus product divided by amount base date 19/6/2005 product divided by amount 45 days 3/8/2005 average due date 3/8/2005 is the average due date. Mehnaz wished to save rupee 150 by way of interest. Let the days be X. So 150 equals 20,000 multiplied by rate of interest is 18%. Days is unknown. X equals 15 days. Mehnaz shall make the payment on 3/8/2015 minus 15 days before, so 19,705. If she'll make payment on 19th July 2005, she'll be able to save interest of 150 rupees. I believe you understood. Let us move ahead. Next question 11. Similar question, homework. Next question, question 12. Two traders, Aslam and Salim, buy goods from one another, each allowing the other 1 month's credit. 1 month's credit. At the end of 3 months, the account rendered as follows: goods sold by Aslam to Salim, 18th April 6,000, 15th May 7,000, 16th June 8,000. Goods sold by Salim to Aslam, April 23 5,200, May 24 5,000. Calculate the amount on which the balance is paid so that no interest is due either to Aslam or Salim. Okay. Solution: calculation of average due date. First finalize the base date. It's a 1 month credit. So 18th April plus 1 month is 18th May. 18th May is the base date. Make 4 columns: due date, number of days from base date, amount, and product. First we are solving for Salim. For Salim payment, the due dates are 18th May, 15th June, and 16th July. 0 days, 28 days, 59 days. Amount 6,000, 7,000, 8,000. Total 21,000. Product 0, 1,96,000, 4,72,000. Total 6,68,000. Next, for Aslam payment, same columns, due date, number of days from base date, amount, product. 23rd May, 24th June. 5 days and 37 days. Amount is 5,200 and 5,000. 10,200. Product is 26,000, 1,85,000. It is 2,11,000. Average due date equals base date plus difference in product in relation to difference in amount. Base date is 18 May. Difference in amount first, 21,000 minus 10,200. 21,000 minus 10,200. So 6,68,000 minus 2,11,100. 18 May plus 42 days. It is 29 June. 29 June is the average due date. Next question. Question 13. Anju and Bobby, two partners of a firm, have drawn the following amounts from the firm in the year ending 31st March 2009. Drawings. Date is given, Anju date is given, and Bobby's drawings is given. Interest at the rate 6% per annum is charged on drawing. Calculate the interest chargeable on drawing. Solution. We are doing for Anju first. For Anju. Calculation of average due date. We need to finalize base date first. 1st July 2008. Make same 4 columns. Due date, number of months from base date, amount, and product. Due dates as given in the question. Zero days, 3 days, 0 months, 3 months, 4 months, and 8 months. Amount as given in the question 1,000, 1,600, 2,800. Total is 5,400. Product 0, 4,800, 8,000, 6,400. Product is 19,200. Average due date equals base date plus product divided by amount. Base date is 1st July 2008. Product 19,200, amount 5,400. So 1st July 2008 plus 3.55 months. 1st July 2008 plus 3 months plus 5 months would be converted into days. It is 17 days. 3.55, 0.55 multiplied by 30 days. 0.55 multiplied by 30 days is 17 days. So this is 18th October 2008. Calculate the interest on drawing. Interest would be charged for 164 days. This is the delay. 164 days is 18/10/2008 to 31st March 2009 year end. Interest chargeable equals 5,400 multiplied by 6%, 164 divided by 365 equals 145.58, which is equivalent to 146. Interest on drawing is 146. I believe you understood. This was for Anju. Do the same for Bobby in homework. I believe you understood. I believe you understood this sum. We are stopping here. We are stopping here. We'll continue. We'll continue in the next class. We're stopping here. Thank you. Thank you.